You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I wanted to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is certified tax coach, certified public accountant, and published author Cody. And in today's show, we're going to be speaking with Craig about both my favorite and my least favorite things in this world. Favorite one being real estate investing, and my least favorite is taxes. But more specifically, we're going to go into detail on very specific tax strategies on real estate investing that can help you keep more of that hard-earned money that you've been making into your pocket. So, and as an added bonus, Craig is going to give you details on how you can snag a free copy of his book titled 10 Biggest Tax Mistakes That Cost Business Owners Thousands. But you're going to have to listen until the very end to find out how to grab that free copy, okay? Before we get on the show with Craig, I've got a few laundry list items I want to quickly run through with you guys. First and foremost, we've just got some crazy exciting things happen here at Sunrise Capital Investors, which, as you guys probably know by now, is our investment arm. That is a mobile home park investment firm that we own and operate. We're full-time investors. I'm a full-time investor. That is my business. And we've got multiple deals in contract right now. We launched the fund earlier this year, and we are currently raising capital. We're looking for partners. If you're an accredited investor and you have an interest in the mobile home park niche, have an interest in higher than average returns, it's an incredible niche to be invested in, both in a good market and even better in a down market, okay? It is probably one of the only, if you wanted to call it recession-proof, it's probably one of the only recession-proof real estate asset classes that I know of. And so if you have any interest in what we've got going on here at Sunrise Capital, want to learn about our partnership opportunities, you can go to our website, sunrisecapitalinvestors.com. You can even download our investment prospectus directly from our website. It's a secure portal for our investors. You can create a username and password. You get access to our private placement memorandum, our investment prospectus, and even schedule a time via calendar link to talk to me or one of my partners about our opportunity. Okay, so sunrisecapitalinvestors.com. And next up, guys, if you find yourself in the Tampa Bay area, I'm based in Clearwater, Florida. You hear me mention this each and every week probably, but I love meeting others that share passion for real estate investing. And so if you're that person, it doesn't have to be mobile home parks either. It could be anything. And you find yourself in Tampa Bay, anywhere here for business or pleasure, whatever it might be, and you've got some extra time, let me know when you're coming. I'd love to coordinate a time to get together for, beer, coffee, dinner, lunch, whatever fits the schedule. You can shoot me an email directly. My personal email address is kevin@kevinbupp.com. And just let me know when you're coming, and we'll try to coordinate our schedules together. And now, guys, without further ado, I'd like to welcome our guest for today's show, Cody. Craig, how you doing today, bud? I'm
doing great. Thank you very much for having me on.
Yeah, thanks for joining us. And I guess first and foremost, Craig, if you would, for those that I guess don't know who you are and just want to learn a little bit more about your background, maybe just take a few minutes. I'm going to pass the mic back to you and take a few minutes and tell our listeners a little bit more about yourself and how you got started down this path of being a tax consultant and CPA.
Oh, great. Yeah. Well, I'm a certified public accountant. I have a firm of 10. I'm a certified tax coach. I'm a business owner. I'm actually a former New York City police lieutenant. In addition to be a CPA for the past 15 years, I'm a certified tax coach. And what a certified tax coach does is we're someone that looks to be proactive with clients. So most accountants, CPAs, are very good at putting the right numbers in the right boxes, but they're reactive. They're looking in the rearview mirror. What we look at is for planning techniques and strategies to help our clients, keep more of what they make. I've actually co-authored an Amazon bestseller, Secrets of a Tax-Free Life, and my latest book is what you mentioned, the 10 most expensive tax mistakes that cost business owners thousands.
Okay, very cool. And I went on Amazon before we jumped on the phone here, and there's got to be thousands of books on taxes, even as niche as real estate investing and how to basically save on taxes, right? How to keep more money in your pocket. And I counted at least 20 titles, Craig, that had the word tax-free, learn how to be tax-free or tax-free wealth, or there's a million different titles that had tax-free. Is that even possible? Is it possible to be tax-free?
Well, I think it's really legally probably not possible to be tax-free, and to be able to live, you need to make some money to live on and pay some taxes.
Sure.
Short of having like a huge loss in real estate that you get to carry back for 20 years or forward for 20 years. But that's not most people. So yeah, tax-free is a bit of a misnomer, but the idea there is you can plan to minimize your taxes and really keep more of what you make.
Mm-hmm. Okay. So tell me about like the right timing. I mean, you kind of gave the definition of what a tax coach is, but what's the right timing for someone like me or any of the listeners that are tuning in that are either maybe just getting started as a real estate investor or already seasoned and they own lots of different properties? I mean, maybe I'm sure they probably have an account at this point in time, but as you define tax coach is completely different, a little bit more of a proactive manner, how you approach things. And so what is the right timing to get involved with someone like yourself? I mean, from a business owner's perspective.
From a business owner's perspective, it's today. Okay. Not tomorrow, not next year, because in order to do real tax planning, it takes some time, and you need to be able to carry out different strategies so you can actually reap the rewards of your tax planning. So it's not a whole lot. When you go see your tax accountant or CPA in February, March, or April, there's not a whole lot he can do for you then. But if you go and you see him today and you talk to him about tax planning, and he wants to be proactive, he can help you today. So unfortunately, most accountants and most individuals, business owners, they think of tax planning as, well, I see my accountant and he tells me how much of an estimated payment to make. So I'm tax compliant. There's a difference between compliance and planning.
So in the planning stages, does that also take into account like even entity formation and choosing the right type of, whether it be an LLC or an S corp or a C corp? I mean, is that something that is involved with being a tax coach?
Yes, it's definitely, because too often what happens is a client goes and they speak to their attorney and they say, I'm going to do this, create something for me, and that attorney likes to create LLCs. Well, maybe that attorney likes to create, corporations or S corporations. And if they just took a little time and you communicated with your CPA and your CPA communicated with the attorney, you could find, okay, what's the best of both worlds? How do we do this to get the best legal structure and also to get the best tax structure?
Mm-hmm. Got it. I want to talk a little bit more specifically about real estate. Again, we're a show that literally interviews, for the most part, real estate investors, and a lot of the people that tune in are real estate investors. And so from a real estate investment standpoint, give us some of the big benefits, of investing in real estate. I mean, what are some of the things that maybe even some listeners might not know are some of the big key benefits of actually buying real estate?
Well, there's obviously the asset appreciation, which is a wonderful thing, but that could take a few years. And then the other thing is the non-cash expense called depreciation. Mm-hmm. So, most expenses you actually have to lay money out to actually get the benefit of them, whereas depreciation is the way the government lets you write off assets. And so a typical rental property is depreciated over 27 and a half years, and there's ways to actually accelerate that depreciation. So you get more of an expense up front than you do down the road. So that's a wonderful thing about real estate. You have this non-cash expense. Can
you define depreciation? I mean, again, we've got a little bit of everything across the board, the spectrum as far as experience. So maybe for those that are just getting started, they might know the basics of what depreciation, what that really means. But what does it really mean in the bigger picture of investing in real estate?
So from a tax perspective, when you buy an asset, and let's just say it's a residential rental property, you spend $100,000 on that piece of property, and we're just saying the building, that's the part that's depreciable. The government says you can't expense that $100,000 in year one. You have to expense it over 27 and a half years. So every year you get to write off approximately $4,000 worth of depreciation expense towards that $100,000. Mm-hmm. So instead of writing it all off at once. So if it's a 7-year asset, maybe the piece of equipment, you write it off over 7 years. And there are different types of bonus depreciation, typically not involving real estate. But then there's something called cost segregation, if we could talk about that.
Sure.
Which cost segregation is a way to accelerate that depreciation. So you bought that $100,000 building, and we're not talking about the land, we're just talking about the structure. And normally you depreciate the whole thing over 27 and a half years. But if we go and we have a study done, and there's studies that can be done very reasonably, they break that building into all different parts. We'd break it into 3-year property, 5-year property, 7-year property, 15-year property. So what you wind up doing is you get more depreciation in the early years and less in the later years. And that dollar saved today is worth a lot more down the road than that dollar saved in 15, 20 years.
Sure. Yeah, and that's something that we don't really take advantage of too much in the niche that we're in, because there's really not, what we're depreciating for the most part is the infrastructure of our mobile home parks, which it literally equates to the roads and the water and the sewer lines, and it's already at a 15-year depreciation schedule. So there's not much of cost segregation that we can do, but as far as multifamily operators, and I'm sure other types of commercial real estate, it's a very important strategy to consider.
Correct.
So I want to talk about deductions. There's I know that we're getting kind of the basics here, but I want to talk about some of the less common deductions that a lot of people know that they can maybe write off part of their home office, they can write off part of their expense of their automobile, whether it be gas or mileage, airfare, hotels, things like that, cell phone. But are there any other less common deductions that might not be known to those that are tuning in?
Yeah, so you talked about the home office, all right? So what the home office does, it opens up a whole nother arena for someone that has a legitimate home office. And there's certain rules you have to follow to have a legitimate home office. But if you have that, then you can actually have a home athletic facility, which can be used for your employees and their family. So, which makes that pool in the backyard now becomes a deductible expense, that home gym a deductible expense, and this is all stuff that's allowed in the code.
If you have employees, though,
you could be an employee. Okay, you could be an employee
you're right.
Of your own.
Fair enough.
Or if you're an LLC and you're a property manager, something like that. So, typically with some planning, you could make sure that you fit that criteria. So the second thing is that failing to plan. People don't take the time to plan. They're going to buy a vehicle and they spend a lot more time researching it than researching ways that they could actually save on taxes. They're concerned about calling their CPA because he's going to send them a bill, versus taking a little time and communicating with him and figuring out, okay, well, maybe it'll cost me a couple of dollars, but I'll save a lot of dollars.
I want to talk more about the pool. This is actually an interesting topic because I'm building a house right now, Craig, and I think we're putting a pool in. So
yes.
in that scenario, and I've got literally a dedicated home office that I'm building specifically to where we have a main office, but I've got my own LLC, which I act. That literally is the owner of the different LLCs that we own. That's one of the members at least. And so in that scenario, I could essentially write off a portion or all, I guess, of that pool expense. Is that what you're saying?
That's exactly what I'm saying, and the code allows for it.
Interesting. I never knew about that one. That's pretty cool.
That's a really nice one. Yeah.
Okay.
It also goes for your gym, if you have a home gym.
I want to talk about, it's not a fun topic, but I want to talk about death. And I want to talk about how tax code applies to us, and this, I'm going back to being a real estate investor, and I want to talk to you about the consequences that occur as far as we own real estate investments and we pass away. What happens with that? Number one, assuming that we have an estate plan in place, but as far as from a taxation standpoint, what happens when we pass and our heirs get our property as far as taxation is concerned? Okay,
so we get what we call step up in basis if it's done correctly. So let's kind of talk about that. Let's just say you own a building that your basis in that building, it's been depreciated, and maybe your basis is $50,000 on that building, but it's worth $500,000 today. If you own that inside of your LLC, when you die, that building gets a step up in basis to the value today, which is $500,000. Your heirs sell it tomorrow, and they basically have no tax. But the problem we see a lot is where people have those pieces of property and they have them inside of corporations. And the problem when it's inside of a corporation is typically the real estate doesn't get a step up in basis. The corporation gets the step up in basis. And very rarely do you want to buy somebody's corporation. You want to buy their assets. Because if you buy the corporation, you could be on the hook for some future liabilities. So if they sell the asset inside they don't get a step up in basis, and now they have this whole tax ramification that they wouldn't have if it was done properly, which took a little bit of planning.
Interesting. I know that's. Go ahead.
That's a mistake we see, very often. Very often.
I mean, do people even use? I mean, nowadays, is it common to see real estate investors use like C corps as their entity of choice, or I feel like that's kind of 2 or 3 decades ago common, before LLCs became a lot more popular. C
corps are rare, but we see them. S corps are not that rare.
Yeah. Okay.
And it you don't get the step up in the S corp.
And I don't want to fall off the deep end here, but I mean, what would be one of the reasons why someone would form a S corp versus an LLC? And I'm talking strictly from a real estate investment perspective.
I would pretty much say no planning when involved. They form them sometimes they form themselves. Sometimes they don't really have a real conversation with the attorney.
Gotcha. So not many reasons why.
There's usually not a good reason. Every once in a while, if it's foreign owned, then there's different,
Sure.
But for the most part, there's usually not a good reason.
Okay. How about like I know we're kind of all over the board here, but there's so many topics where we can go, and there's a lot I want to cover here in this short time that we have together. But as far as 1031 exchanges are concerned, I think most everybody probably knows what a 1031 tax deferred exchange. I mean, is that something that your firm advises on as well? I know that you guys aren't probably an intermediary, but is that something that you have a lot of knowledge in?
Yeah, we've been involved in a whole lot of them over the last, I'd say, probably 15 years. And sometimes we see, they're accounted for incorrectly too. A big mistake you see with 1031s is they start the 1031 in October, the 1031 fails in March, and then they wind up picking it up in October on their income tax return, and they probably didn't make estimated payments, and they get these big penalties.
Those retroactive.
And when really it should have been picked up in the following year. And it could be, penalties. We had one where it was a big sale, and wound up having to go back and amend it, and saved the client a lot of money in penalties.
So there's a way to set up the 1031 to where if it's carrying over to the following year, there's a way to set it up so that it doesn't become retroactive.
Right. Well, if it's done correctly, it flows in, and it flows into the taxes of the following year, not the preceding year.
Gotcha.
Because remember, you don't have access to that money.
Yeah. Tell me, what are some other things that we need to know? I want you to put yourself in the shoes of you've got 10 minutes or 15 minutes to give anything we haven't covered so far, but you're in the room full of fairly new real estate investors, maybe a few that are somewhat seasoned, but fairly new. What other advice would you give in a short period of time that you feel is incredibly relevant and important to know, assuming that we only have 10 or 15 minutes left to chat?
Well, the most important thing is to communicate with your professionals. You should, if you're in this business and it's a business, you should have a team of professionals. You should have an attorney. You should have your advisor. You should have your CPA, and they should be part of your team, and you should be communicating with that team. All right? They're there, use them. Get the value out of them. So some other things that, from a planning perspective, that people should be doing is, there's, if you own real estate, you can, have companies that manage your real estate. You could hire your kids inside of those companies to manage your real estate. And then, like the first $6,000 is not taxable. So if you do it correctly, and you have to document everything. Tax court says you could hire your kid as early as age 7. We typically don't recommend that. I like to see 11 and 12-year-olds or older. And then let's just say your kid goes to a private school in Florida. Okay, you can now make that private school tax deductible because you pay your child. The money goes into his bank account, and then the monthly draft for the school comes out of his account. So you've made a non-deductible expense a deductible expense.
Interesting.
Another thing is missing medical benefits. People with large out of pocket, whether it's braces or older people when they have a lot of cosmetic stuff done, can set up a medical expense reimbursement plan. And now all of a sudden you can send that $10,000 or $15,000 medical expense that you really would not get the benefit of, and make it 100% deductible.
Interesting. Okay. I didn't know that either. I'm learning all kinds of new stuff.
all good stuff. All good stuff.
How about what are some qualifying questions that if we're going to go out and we're going to seek a tax professional, a tax coach, what kind of questions do we need to be asking to qualify this individual to make sure they're the right fit for us?
Well, you want to talk to them about, how often do you communicate with your clients?
Okay.
Because
is there like a set schedule typically? What would your answer be if I asked you that question?
We like to communicate with our clients on a regular basis, and regular could be monthly. And
Okay.
with the advent of Skype and Zoom, you're not driving somewhere for a half hour, sitting down with somebody and driving back. You're going into your office, closing the door, and you're having a 15-minute or 20-minute, 30-minute phone call, and you're seeing what's going on, and you could get a lot of value out of that.
Mm-hmm.
So communication is really the most important thing. Obviously, you want to make sure that the person is, in my case, you want them to be a CPA, okay, or an enrolled agent, all right? Somebody that knows what he's doing, has experience in the real estate field if you're in the real estate field. Recommendations is always a good thing.
I was going to ask, like you bring up the point of making sure that they have experience in the real estate field. I mean, what would be validation for experience? Like, I have, 40% of my clients are in the real estate space, or we've got a tax accountant in our firm that 80% of his clients, like, it's all he does. Or what is the right qualification as far as real estate specific experience from a taxation standpoint?
I think somebody that's been involved in that field for a while, and somebody that's going to make you feel comfortable that they do have that experience. And let's face it, the proof is going to be in the pudding.
Yeah.
And unless you talk to references, you're going to have to really trust your gut and feel that, okay, this guy knows what he's doing. He talks a good talk, so let's hope he knows what he's doing.
Mm-hmm. No, absolutely. I want to talk about your book a little bit, Craig. 10 biggest mistakes. Maybe you can give us like 3 of them, but and then after you're done giving us three of the 10 mistakes, share with our listeners how they can grab that free copy. I told them they had to wait to the end, so
okay.
the suspense is hanging. So once you share those 3 of the 10 mistakes, you can tell them how they can get that free copy.
Sure. Well, we talked about a couple of these already, so I'm going to run through a bunch of them. We talked about failing to plan. Okay. We talked about having the wrong business entity. We talked about missing family employment. Can you hire your kids? Can you hire your wife? A medical expense reimbursement plan, medical benefits, missing a home office, and what does a home office open up to you? All right. Car and truck expenses, meals and entertainment. Those are, a number of things. And, a little plug here, missing my help.
What was that again? What was the last one?
Missing my help.
Missing your help.
Yes, meaning missing the help of a CPA.
Oh, gotcha. I gotcha. It went right over my head, Craig.
Sorry about that.
Okay.
So sometimes we talk a little bit fast up here north.
I'm from the north. I'm from Pennsylvania, but I'm not as fast. You're in Boston, correct? Is that where you?
No, New York.
Okay, New York. Gotcha. Yeah, you guys are a little faster than us Pennsylvanians. So how can we grab a free copy of that book, Craig? Okay.
So they could go to our website. We have a special URL for your listeners, which is going to be www.craigcody.com/REI cash flow.
Okay.
So that's Real Estate Investors Cash Flow. So it's REI Cash Flow. And they can fill out the link, and we'll send you actually a free paper copy of our book.
Fantastic. And guys, I will put that in the show notes as well, so you'll be able to grab it from there if you can't remember it. I know my memory is horrible, so I'd probably forget that in a heartbeat, but I will put it in the show notes for you. So, Craig, now we enter into what I like to call the Golden Nugget segment of the show, and this is where we're going to kind of wrap things up for the day, but I'd like to ask if you had just one final last Golden Nugget of advice or wisdom that you could leave with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last Golden Nugget be?
Communication. Assemble that team and communicate with them. You'll get so much out of it, and it'll really pay great dividends.
Yeah, communication really is the key to anything, right? To any successful relationship, whether it be professional or personal, whether it be between you and your business partner, or you or your spouse or your significant other. I mean, like, communication is the key to everything. And no, I think that's an incredible piece of, it's literally simple advice, but incredibly powerful. So, Craig, really appreciate your time today. Really appreciate you coming on the show. And for those that are listening in that want to learn more about Craig and his company, you can visit him at CraigCodyandCompany.com. Again, that's CraigCodyandCompany.com. And Craig, just one last time, tell our listeners how they can grab that free copy of that book.
It's www.CraigCodyandCompany.com/REI cashflow.
You got it. Craig, thank you so much. You have a fantastic day. Talk to you soon.
Thank you for having me. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.